Hey, you guys. All right, here's what we're going to do for chapter 8. I told y'all before the test today, about 40% of your next exam is going to come from this chapter. It's depreciation, depletion, amortization. We call that cost recovery. So bear with me for a second. Don't skip the video yet. About 40% of your next exam is going to come from it because it's really important in business, not just if you want to be a tax accountant. It's really important in business. This third exam is the lowest of all four of my exam averages. So I know this is a part that students need to practice with. The good news, I think, is if you're more of a problem worker, there's a lot of problems in this chapter. You know how in tax, a lot of times we're just reading and memorizing rules. There's a lot of problems in this. So if you're cool with doing a lot of homework and problems, this should be a good chapter for you. Before you start this, I had 3 reminder videos that I used for my principles of financial accounting about what depreciation is, how to do depreciation, and like a small little basket purchase. Can you do that? I used to say, hey, if you think you need it, go over that. What I'm going to say now is probably all but one of y'all need to go over that. Just is what it is. If you haven't done it in a while, you've got to take the time to review that because we pick up assuming that you'd make 100 on a depreciation test in principles and how to do a gain or loss. But what I know is that I've given y'all a gain or a loss on several quizzes, and some of y'all are still missing it. So you have to back up and take the time to do that. Okay. So I'm going to go through this just like we were in class. What I know, because Canvas shows me metrics of if you watch the video or not, or if you skip every 5 minutes and just watch for 20 seconds and then skip another 5 minutes. I know that y'all do that a lot, some of you. I'm going to ask you to put on your big girl britches and pretend like you were sitting in class and you can't skip. You need this information. Try to pay attention when I say this is a struggle point. Try not to make your Target shopping list out over here and have your phone in your hand while the video's on and be scrolling TikTok. Y'all can all concentrate at work when you have to, concentrate at school, especially if you're not passing the course right now. All right, that's my mama speech. Let's get started. Chapter 8. Again, it's called cost recovery because anytime a business spends money, they'd like to take a deduction for it, right? And in chapter 6, we learned that most business expenses are, in fact, deductible. So, same way, if a business buys a long-term asset like a building or land or equipment, that should be a deduction, right? And you guys learned in Principles of Financial Accounting, and then you go over this again in intermediate, that when a company spends an expenditure, they've got 2 options for how they can record it. They can record it as an expense right away, or they can capitalize it right away. So I want you to stop the video and explain to your cat or dog what capitalize means. And if you can't do that, then no, you've got to stop the video and learn that right now. It just means to record an expenditure as an asset. We do this the very first week of Principles of Financial Accounting. Joe's company bought a building. The transaction goes a debit to building, a credit to cash. We don't expense it right away. And you learned in financial accounting that that's because that asset, if it's long term, it's going to help you earn revenues over more than just the 1 year. So we don't want one big fat expense on just this year's income statement. We want to break that expense up into a whole bunch of years, right? So we're going to kind of do the same thing in tax, but we have some different rules. For tax purposes, it's a little more lenient. We're going to be able to expense faster than we can for financial purposes because our goals for tax are different. For financial, our goal is to match the expenses with revenues. Taxes, we have that wherewithal to pay concept that says, we don't do this all the time, but we recognize the inequity of taxing something when the taxpayer doesn't have the means. So if I pull 100 grand out of my pocket to buy a piece of equipment, the wherewithal to pay says, hey, let her deduct it all this year. She doesn't have that 100 grand anymore. So that's kind of the background of what we're doing. Recall that depreciation, so I say a lot of my notes in here, I'll say depreciation, but know that amortization and depletion are similar cost recoveries. Depreciation is just for tangible equipment. Amortization is for intangible equipment. And then finally, depletion is also tangible, but specifically natural resources. So all of those things together are used for on property used in a trade or business, and property held for the production of income. And remember, we've briefly talked about before, gosh, those sure sound the same. It's going to get into like, this would be like for a rent house, a profit motivated activity. So they're both deductible. It's just in chapter 11, we'll learn sometimes your investment types of property might be a little more limited, those deductions. But what about personal? Remember in chapter 6, we said there's 3 types of deductions: business, investment, and personal. So where's the depreciation on personal property? It doesn't exist. We don't take depreciation on personal property. Also, we don't take depreciation on land. Why is that? Well, things that have an indefinite life, we can't use up, right? So I always say, like the land you're standing on, that was there when God created the earth. It's not going anywhere, except for every now and then there's a sinkhole. So I don't know about that. But in general, right, land doesn't go anywhere. There's some weird things like some antiques that they say, hey, we're not using that up. That appreciates with time. So we're not going to depreciate that. But for the most part, those things we depreciate. So why is a depreciation deduction allowed? All of these 4 bullet points you can read about. These are sometimes where y'all struggle in multiple choice questions. You're like, hey, you know what I'm good at? I'm good at memorizing a formula and working out a problem. Well, computers are good at that too. So nobody's going to give you a job doing that. You need to be able to think through, why is a depreciation deduction allowed? Well, because it's an expenditure just like every other expenditure. And Congress has said, hey, we're not going to tax on gross income. We're going to let businesses deduct the cost of doing business and tax on that net taxable income. I just talked about the wherewithal to pay concept. Hopefully you remember. If not, I know for a fact some of y'all don't, because I always ask this on a quiz and a test and somebody always misses it. So go over that. And then finally, I've just answered this for you as well. Tax depreciation is usually not the same as GAAP financial depreciation each year. Tax has some more lenient rules to let us take the expense of that cost recovery a little bit faster. Okay, this is new to a lot of you guys, so I want you to really understand this because, again, these are just business terms. These aren't accounting terms. These are business terms everybody should know. Real property is, you can read about it. Here's my definition: stuff you cannot move. What would an example be? A building or some land. Personal property, I love definitions like this: everything that is not real property. Ha, that's like a circular definition, right? So what would some things be? Equipment, furniture, computers, a car, stuff like that. Got it? Now, these are just 2 categories. Out of these 2 categories, you can either use these things for personal use or use these things for business use. I have a house I live in, and that is personal use, real property. I also have a rent house, and that is business use, real property. Okay. I have a car that I drive to work every day. That is personal use, personal property. But if I used that car only for my business, it would be business use, personal property. So this little term right here is what drives everybody bananas. But it says personal. It's got to mean she needs it for personal use. Nope. Personal property just means not real property. This got some of you guys on the tax return we just did. On the Schedule A for property taxes, there was a line that said real estate practices, real estate taxes, real property, real estate taxes. And that's where y'all should have put your real estate taxes. But some of you put it down with personal property taxes instead of the real property. So let me know if you have questions about that. You really need to quiz yourself and go through some examples to get that down. So to kind of understand it, I said, compare this to what you learned, and we're going to dive right back into later some capital asset stuff. The classification is based on the use of the property, not the property itself. Like, I've got a house. If I ask you guys, is that personal use or business use? I don't know. Tell me what you use it for, right? And only if it's for business or the production of income can you depreciate it. We never, ever, 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 ever depreciate personal use property. I'm not going to spend a lot of time going over this, but I want you to, because this is your understanding of depreciation. You can't just have memorized how to do straight line or double declining depreciation and go, oh, I got the formula down. It's not going to cut it in this chapter and in this class and in real life for you. So, quick little example, John starts a graphic design business, and to make it easy, I said in the first year, he has an expense of $50,000 where he buys some new equipment for cash. And I said, assume that is his only expense and that he earns 50 grand in revenue and receives it in cash for the next 5 years. So here's his cash flow. He gets 50 grand in cash every year for 5 years, and he only spends 50 grand the first year. So the first year he has no dollars left in his pocket, right? He got 50, spent 50, nothing left. And every other year he has 50,000 left in his pocket, so that when you get to the end of the 5 years, he got $250,000 cash, he spent 50, he netted 200 grand cash. How does that flow out for financial purposes on the income statement and balance sheet? Well, that again, that matching principle and GAAP tells us we can't take all 50 here. We're spreading it out over 5 years. It's useful life because that 50 grand we spent is helping us earn revenues each of the years. So what does this company, if this is how we did our depreciation for tax purposes, what do they pay taxes on? Man, they got to pay taxes on $40,000 the first year, even though he had no dollars left in his pocket at the end of the year. That stinks, but those are the rules. But when we get to the end of the 5 years, it looks the same as it did up here. So depreciation just causes a timing difference. And then to remind you, here's where some of you have been struggling when you try to find your gain or loss. The first thing you have to do is figure out your book value. We call it adjusted basis in tax. So your original cost never moves off the balance sheet, right? The way we move it is through accumulated depreciation. And in year one, it'd be 10. Year two, 10 plus 10 is 20. Year three, 10, 10, 10, 30, 40, 50. To where in the fifth year, this company has a zero book value on their balance sheet. They've got a zero adjusted basis for tax purpose. So anything they sell it for above zero, they'd end up having a gain. Or if they sold it at the end of the first year, anything they sold it for over 40, they'd have a gain. So that's it. You sell it for more than the book value, it's a gain. Less than the book value, it's a loss. Stop your video. I'm going to work this problem real quick, and you just make sure you can do this gain loss, okay? Okay, couple of things about this. You guys can just check your work real quick. Number one, I sure hope you stopped the video and did the work and don't just look at mine and go, okay, 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 especially if you've missed this on a quiz. Again, don't go forward until you've got the basics down. So first thing you've got to do is find your book value, and then you take your selling price minus your book value to get your gain or loss. Some people on this last quiz where y'all had this problem took their book value minus selling price, and you got it tangled that way. Some people took selling price minus just the the accumulated depreciation. So there's always two steps. First, find your book value, then find your gain or loss. Second problem, we sold it for less than our book value, so it's going to be a loss. So don't forget to, set it up right so that you might get the right number, but you've got to make sure it's a gain or a loss. All right, come see me if you need help with that. I move on assuming that you just know it, but if you're the one that needs help, that's okay. Come into my office or tell me you need a Zoom and let me help you, okay? All right. So the tax code requires taxpayers to use certain specific depreciation methods, and it's going to depend on when an asset is placed into service. So there's actually three different methods. we're going to focus right here on what most people commonly call MACRS, stands for Modified Accelerated Cost Recovery System, but people just say MACRS. That's because this has been the method in place since really the beginning of 1987. Congress has not changed MACRS since then. Before that, we had this special kind called acres through these years, and there are still some things that are in place for acres. But I don't quiz you guys on acres because it's like property placed outside of the United States, and there's just some different things. Mostly we're using MACRS. And then there was an even different method before 1981. So again, we're going to focus on MACRS, and then listen carefully. This is going to sound like a trick question on the exam. Sometimes y'all hear me say something in class and go, yeah, that made sense, but you don't bother to read about it and actually memorize it. Straight line depreciation is always allowed in tax. MACRS is what Congress created for it, and we can use that. But if you'd rather use a slower method and spread it out longer, you can use straight line, and we'll talk about why you might do that later. Okay, let's go back to that basis of the property. Hopefully you've got an idea in your head of what basis means. Remember in that example we just looked at, I said it's like your book value. So the basis starts out at the original cost of something. We'll go over that. And then when I'm always writing adjusted basis, it's because we can adjust it. It goes down as we take depreciation, and it might increase if, say, I had an office building and I added a wing onto it. That would increase the basis of my building. Okay. So once we figure out the basis of a property, each year the taxpayer that owns that property has to reduce that by what's called allowable depreciation. And that's whether you took the depreciation or not. And you go, well, Jennifer, why wouldn't we take it? Well, what if I'm going to have a loss my first year? And so I don't need any more depreciation. Doesn't matter. I have to go ahead and take it because I'm going to reduce my basis by that anyway. Why? Why do we have to reduce basis? Well, look at John's example with the $50,000 of equipment and notice how his adjusted basis is going down each year until it gets to zero. We keep track of basis because once it gets to zero in year 6, John cannot take any depreciation expense. None in year 6. Can he keep using the equipment? Yeah, you can drive it or use the computer or whatever until the cows come home. But once your basis hits zero, you have taken a deduction for all $50,000. You can't deduct anymore. So that's why we keep track of base. Okay. So what is that initial basis? Again, you learned this in Principles of Financial Accounting. Generally, it's the original cost. I paid 50 grand for that computer. But what are these other costs necessary to get it ready to use? Well, I might have had to pay some sales tax. I might have had to pay to have it shipped to me. If it's some kind of specialized equipment, I might have to pay to have it installed. So all of those things would get capitalized. We just talked about what that word means, and we would record that whole amount as an asset and then depreciate that whole amount out later with the asset. So cost recovery, we're going to, like I said, just use the word depreciation for now, is based on that return of principal, or sometimes I write it like this, return of capital concept. You are recovering the basis for what you spent on it. When do we start depreciating an asset? When can we start taking that deduction? The day we purchase the asset or the day we place it into service? It's when we place it into service. So if Bob purchases a piece of equipment on December 15th for his business, but he doesn't start using it until January 11th, when can he start taking depreciation deductions? Well, not until January of the next year. And so you think, well, why does that matter? Why are we going over this? Remember, most taxpayers are cash basis. This prevents them from buying a bunch of stuff they don't really need yet in December, so they can go ahead and take deductions for it, and they really don't need it until next year. If you're not using it until next year, you cannot start depreciating until next year. Okay. How are you doing? Y'all hanging with me? Up next. So I call a lot of rules from here on out flashcard rules. I've mentioned those to you before. I'm suspecting some of you aren't using flashcards based on your grades. When I say things like that, y'all, I'm not calling any one particular person out. You know if you're making the grade you want to make in here or not, and you only need a 70. You need a C to pass. So if you're making a 70 and you're cool with that, I promise you I'm cool with that. That says average and you're getting there. But if you're not passing, unfortunately, you're not doing everything you have to do to get to it. So I'm not fussing at you. I'm just telling you, look, you got to do something else. Flashcards are the something else, especially over a few of the things we go over in this chapter. So, okay, adjusted basis. Remember, I said we know our initial basis now. We're going to adjust it. And it's the amount that hasn't been recovered yet. So it's that original cost minus the accumulated depreciation. Again, look at our John example. In year one, the adjusted basis was 40,000. Can you see how that makes sense now? That's the amount that has not been recovered yet. In year two, our adjusted basis is 30, 20, 10, 0. So adjusted basis can change up until the day you hit 0. And it's similar to what you've already learned in financial accounting about book value. So how do you know if you should capitalize something or if you can expense it right away? And I said, the general rule, there's going to be exceptions, right? But the general rule is the same as financial accounting. If that asset lasts you longer than a year, capitalize it, record it as an asset, and then depreciate it out over a certain number of years. The difference is in tax, Congress is going to tell us how long we depreciate an item, whereas in financial accounting, the company can choose, right? However, there are a lot of exceptions in tax that's actually going to let us depreciate things or deduct that cost faster because, like I mentioned earlier, that wherewithal to pay principle. And then also, there's this random de minimis safe harbor rule that allows taxpayers, I don't care if it's a stapler that's going to last you for 25 years or what, it says, hey, if you choose this safe harbor rule, you can just go ahead and deduct everything below a certain amount. Maybe it's a microwave for your restaurant that cost $1,000. Fine, go ahead and deduct it. Y'all, make a note, a star. You don't have to memorize those amounts, okay? Next page. Basket purchases. I'm also going to stop the video here and work this. You should remember this from Principles of Financial Accounting. Okay, I'm not going to explain this because I have a separate 4-minute video in Canvas or on YouTube or wherever you want to watch it about this. But you can see I paid 200. It was worth 250. We can't make that journal entry. I can only record these at what we paid for it. So go back and watch that video if you need to on that. Remember, most of y'all need to. Okay, what about additions once we buy a long-term asset? Again, I own a building and I add on a wing or a remodel or whatever. Pretty much the same as financial. It depends on if it's just a repair, there was a hole in the wall, or if I put up a bunch of new walls, if it extends the life of the asset. Your book has a little paragraph about this. Take the time to read it. All right. Other basis calculations. Stop for just a second and don't just go, oh, here's more words in another calculation. What does it mean? Why are we doing something different? Well, what we just went over assumes we were purchasing the asset, and we discussed how that initial basis comes around. But what if we didn't purchase the asset? What if I already had the asset, like a house I used to live in Flint, but then I converted it to business use and now it's a rental property of mine? How do I figure out what the basis of that house is going to be? Is it going to be what I paid for it when I bought it or what it was worth at the date of conversion? And so this is another flashcard rule. Y'all, believe me, if there was ever a chapter to use flashcards, this chapter is it. On the back of this flashcard, you're going to write this, and on the front of the flashcard, you're going to write basis of asset, personal use to business use. And then if you're cool and you're going to go get your graduate degree and sit for the CPA exam so you can make about a couple million more dollars over the course of your life, you're going to use these same cards when you get to tax 2 to help you remember it. You're going to use them again when you take the CPA exam. It is worth your time to make them. I know that Quizlet makes delightful little flashcards, and Quizlet's great. Use it to quiz yourself. But I also know from personal experience, and because Harvard has done a lot of research on it, that if you take the time to take one of these things, it's called a pen, and you actually write it on the flashcard, that is your brain learning and remembering rather than having Quizlet or ChatGPT do it for you. So you can believe me or not, and if you're making the grade you want to make, you figured it out, y'all. I'm just offering these tips to help you because sometimes I know that you're busting your booty and working really hard and your grades just aren't showing it. So let's change something up, okay? So, all right, we had it for personal use and we switched it to business. Our rule is going to be this. You can try to memorize these rules, but there's so many, they're going to get tangled in your head if you don't understand why. So why have this rule? It's like what we discussed in the last section, the last module with dealing with losses. It prevents the taxpayer from being able to take a deduction on personal use assets. Let's look at this example. Suppose I sell my used car today for 15 grand. That's the selling price. When it cost me 45 grand, that's the basis. If that is a personal use car, that's also my adjusted basis because I didn't take any depreciation on it. So selling price of 15, adjusted basis of 45. I have a 30,000 realized loss. What is my recognized? Remember, recognized means, ooh, I see you. I'm going to put it on the tax return. Well, because it's a personal use asset, 0. We can't take personal use losses. So I have this idea and I go, I know what I'll do. I'll convert the car to business use and then sell it. And because business losses are allowed. But remember, we already talked about, no, can't do that. So here's another reason why we can't, or another thing that would prevent us from, okay, so I don't sell it. I'll just put it in the business and then I'll continue to depreciate it. I'll take deductions for it against my business income. Nope. Can't do that either. What would the basis of the asset be in the business after I convert it? Well, it's the lesser of either this cost basis or the fair market value today. So the fair market value of 15 is the lesser of the two. How do I know it's fair market value today? Well, because that's what I can sell it for. Fair market value is just what somebody else is willing to pay for it, right? So now I convert it to business use. My business basis is going to be 15,000. And that is how much I can deduct for depreciation over however long I've got to take it. Not the full 45, just the 15. And it's because that other 30,000 was from when I was using it personally. All right. Flashcard 1 for basis there. You can do another flashcard if you want for that basis of items used that we got by purchasing. You start with the original cost, add all this other stuff to get it ready to use, that kind of stuff. All right, that's page 4. Page 5. Here's another flashcard. Now, instead of buying the asset or it was personal use and we converted it, now somebody gave it to us as a gift. This is generally called the same basis as the donor's basis. And I always use this example. Hopefully this is really easy to see. Ben's grandma gave him her house, which had a basis to her. So she's called the donor, someone who gives something. The basis to her, donor's adjusted basis was 150. But today, the day she gave it to him, it was worth 300,000. That's my fair market value. And she gives it to Ben, and Ben goes, "Thanks, Grandma. I already have a place to live, so I'm going to use this house as rental property. Therefore, Ben needs to know what his basis is in the house because he's now going to depreciate or take deductions on that rental property. What is Ben's basis? So for property received as a gift, we just wrote down the rule. Before you go to writing a number down, I would write same as donor's adjusted basis. And then I've already labeled things up here. So I'd go, oh, it's not that. That's the fair market value. Ah, it's 150. So Ben's basis in that house is going to be 150 grand. And eventually that's how much he will deduct in depreciation expense on his tax return on Schedule E for that rental property. Okay. What if instead, the day Grandma gave it to him, Ben decided to immediately sell the house? What is his gain or loss? Stop the video. Don't come back and look until you've done that on your own. That should be really easy. Well, Ben would sell it for what it's worth of 300. His adjusted basis, because he never ended up using it as rental property, is what it was on the day he got it as a gift. Ben would have $150,000 gain that he would pay federal income taxes on. Okay, makes sense? So here's your flashcard. On one side, you're going to write basis of gifted property. And on the other side, you're going to write donor's adjusted basis. All right, third flashcard. Now, basis of assets received by inheritance. This means somebody has passed away and left you something. So we're going to use the same example. Instead of Ben's grandma giving it to him while she's alive, she passed away and left it to him in her will. Well, this rule, front of the flashcard, back of the flashcard, it's generally the fair market value at date of death. So same house, Ben's grandma died and left it to him, basis of 150. So I'm going to say donors adjusted basis, fair market value of 300. Ben decides to use it as a rental property. What is his basis? It's 300,000. That means he can deduct $300,000 here instead of only 150. This is called a stepped up basis, or it's also referred to as a step up in basis. So now let's do the same thing. What if Ben immediately decided to sell the house? Grandma passed away last week. This week he decides to sell it. What do you think he could sell it for? Still probably what it's worth, right? 300 grand. His adjusted basis is now what? 300. Fair market value at date of death. Oh my gosh, now he has no gain. Up here we did. Which scenario is better? This is not financial accounting. Don't just go, oh, gains are automatically better. In either scenario, Ben got a $300,000 house. Up here, he has to pay taxes on a $150,000 gain. Down here, he pays no taxes at all because there is no gain. So if grandma's older and she thinks she's not going to live that much longer, what would you advise her and Ben? I would advise her to just hang on to the house and leave it to her in her will rather than giving it to him today. Make sense? Even if Ben holds on to the house for 10 years and sells it later for like 310,000, the adjusted basis of 300 is always going to be better than an adjusted basis of 150. Okay, stop the video for a second, shake your brains out, check your phone if you need to check it, and then put it out of your sight so that you can pay attention and keep focusing on this. I know it's a lot, but I also know y'all can do this. Now let's get into the nitty-gritty. That was basis information. Hey, also, just as an incentive to get you to do these flashcards, this is on exam 3. Your final exam, we do some different property transaction stuff, and I'm going to start chapter 14 by saying, hey, y'all remember all of that? Pull out all your flashcards. I'm not teaching that again, but y'all have got to know all that, and we're going to build on it. So hopefully that gives you some incentive to really get this nailed in this chapter. All right, let's move on to calculation of depreciation for tax purposes. Okay, remember how you learned that salvage or residual value means the same thing in financial accounting? Um, for tax purposes, and this whole chapter, we're just going over tax purposes, right? We never use salvage value or residual value. Yay, one less thing to think about. Because for tax purposes, man, we want that whole deduction, right? I want to deduct every penny of what that asset cost me. So no salvage value or residual value. The property must be put into specific assets based on the type of property and the number of years to depreciate it. And again, remember earlier I told you Congress is going to tell you what those years are. There's like 5 years, 7 years, 10 years, 15 years, blah, blah, blah. More on that later. Remember I talked about straight line. You can choose straight line, or you look at these MACRS tables that Congress came up with, and the MACRS tables actually use this combination of straight line and accelerated methods. But if it's real property, y'all give me some examples real quick of real property. Remember, building, land, stuff you can't move. If it's real property, it uses only straight line. You don't have the choice of using that MACRS where it depreciates faster. Okay, here's the part where students are like, what? I've never seen that before. There are these different conventions. These are assumptions that are made about property that you place into service and their disposal date rather than when you really placed them into service. So the half-year convention applies to tangible personal property, not personal use, personal like furniture, computers, equipment, vehicles used in business, okay? It assumes that the acquisition, that means when you got it, or the disposition, when you got rid of it, are made at the midpoint of the year. Jennifer, what if I placed it into service on January 2nd? It assumes that I placed it into service at the midpoint of the year on July 1st, regardless. What if I placed it into service on October 1st? Midpoint of the year. Okay, then because Congress is hateful, they came up with something called mid-quarter convention. This is also tangible personal property, and it is required if more than 40% of the property is placed into service during the last quarter of the year. I want y'all to write down what the last quarter of the year is. Stop your video and tell me what months that would be. January, February, March, April, May, June, July, August, September, October, November, December. That is dividing your year up into 4 chunks, which is what a quarter is. So just October, November, and December. Sometimes I have people tell me that September is part of the last quarter. So if you need to sit there and write out your all 12 months of the year and figure out what the last quarter is, then that's what you need to do to make sure you get that right. Okay, finally, we have a third convention called the mid-month convention. This is strictly for real property, and it assumes acquisitions and dispositions, rather than being made at the midpoint or mid-quarter of the year, they're made at the midpoint of the month during which the transaction occurs. Okay, so y'all should know by now, like when I'm doing fill in the blanks, it's because I want you to know that. So as you're studying for a test, pull back up some blank notes and go back through and see if you can write these things down, if you can remember them. If you can't, then you know you've still got to work on that some more. And frankly, you should kind of do that like at the end of each chapter after we've gone over all the notes. And then you're just reviewing it real quick before the test, right? Okay, let's see what we have on page 6. To recap what we just discussed, you've got to know the method, the recovery period, and the convention used. So the method means like straight line or MACRS. The recovery period, is it going to be over 5 years, 10 years, 15 years, whatever? And the convention, is it the half year, the mid-quarter, or the mid-month? Don't just read these words and like your eyeballs are doing all the reading and your brain can't keep up, right? Make your brain understand it before you move on. So here's an example. Golden Corporation, their calendar year taxpayer, purchases a business use machine on March 10th, 2022. For depreciation purposes, under that half-year convention that I said we have to use, if it's tangible, personal property, the machine is treated as if it were placed in service on July 1st, mid-year, half-year convention. Therefore, only 1/2 year's depreciation is allowed for that first year that they use it. So that half-year convention assumes, remember, that all acquisitions the year you buy it and dispositions occur at the midpoint of the year. So let's look when they go to sell it. Now they go to sell it way on October 30th of 2024. They've held that thing for 10 months that year. How much depreciation will be allowed in 2024? Only a half year, because the year we acquire it and the year we dispose of it, you only get a half years of depreciation. So Golden purchases a building now. Uh-oh, that's not tangible personal property. What is that? That's real property. They purchase a business use building on March 5th, 2024. Shut my video off and see if you can answer this without looking at the prior page. If you've got to look at the prior page, then go ahead. So which convention applies? We call that mid-month, not mid-year, mid-month, because it's real property. And so the building is considered to be placed into service on March 15th that year. So how many months of depreciation for the building are allowable for 2024? Well, we don't allow January and February. That's out, so that leaves us with only 10 more months. And then only a half a month for March, so only 9.5 months that year, okay? Whew, okay. Let's look at tangible personal property. How do we know? Remember, I've got to know the recovery period. How many years is it going to take me to depreciate this sucker? Well, lucky for us, the IRS just tells us. Y'all, you do not have to memorize what's in these. But in the real world, in fact, I wish I had gotten my book down. I've got a book about this thick. We can't see. It's about this thick. It's called a depreciation book. And I can look up everything from a mama cow to a baby cow to a cow I bought versus a cow I raised on the farm to a billboard to a gas station, whatever, and it will tell me how many years I depreciate it. I don't get to decide. Congress and IRS tell me, and I'm not making y'all memorize that. So on the test, I'll just tell you it had a 3-year life, a 5-year life, a 7-year life, whatever. Most of the stuff we use, 5 and 7 are the most common. You can see 5 years are computers, automobiles, 7 years like your office furniture and equipment. Everything. I'm looking around on my desk and I've got a phone, I've got a file cabinet, I've got a desk and a bookshelf. So those are your most common. All right, what is this MACRS you speak of? MACRS for all of these are based on, remember that double declining you learned in principles? Don't worry, I'm not going to make you calculate it out by hand, but they're based on that double declining and it gets less and less and less every year. Well, at one certain year, straight line would end up being more. And so MACRS switches to straight line when it's more. So ultimately, what's the point? The point is to get businesses to be able to take deductions faster for tax purposes than they can for financial purposes because of that wherewithal to pay thing. And then remember, once that basis hits zero, no more depreciation. You have expensed the entire cost of the asset at that point. All right. I wish y'all were in class. I would like be doing recalls. Sean, what is this? Diana, what did I say about this? Derek, what's this one? So make sure y'all are kind of quizzing yourself as we go. Let's work our first real problem. In March of year 1 of her business, Mary acquires and places into service a business machine, which cost her 20 grand. We call that the original basis, right? I didn't throw anything extra into this problem. I should have. She paid sales tax, shipping, installation, whatever. We'll do more of that in chapter 14. What is the depreciation deduction in year 1? I really want y'all to follow this through because this is how you see what is going on rather than just trying to memorize a formula and then you get tangled in the formula on the exam. Double declining depreciation said 2 for double divided by 7 years. That's her business machine. 2/7 is going to be our rate. 20 grand. Well, let me start with that. 2 divided by 7 is our rate times $20,000 would be 5714.29. That would be our double declining amount if we were doing this for financial purposes. But remember, tangible personal assets, we use that half-year convention. So that's why I'm multiplying it by 50% or dividing it by 2, whichever way makes more sense in your brain. And then Mary can only take this much in depreciation for tax purposes this year. If she was doing GAAP, she'd take this much for her financial statement, but half-year convention and tax only this much. So it's just a timing difference. Ultimately, we can take the same depreciation. It's just timing. So how do we do the depreciation on charts? That's what you're going to do on your exam. Can you do it double declining? No, because remember it switches and does straight line later on. So you've got to use these charts. I am going to pass these out to you when I see you next in class, but they're uploaded to Canvas and you will have exactly this on the test, and there are several pages to it. The very first page says, this is MACRS, and this is the half-year convention for personal property placed into service after 86. Remember? Good. We're definitely after 1986. That was a fantastic year. I moved to Texas. Oh, no, I moved here in 85. Okay, you don't care. It was fun for me, though. Half-year convention. What does this chart mean? We find what recovery period is. Remember, the IRS tells us, and Jennifer, I get to play the IRS on your exam. I'm just going to tell you. On this one, we said it's a 7-year recovery period. All right. What are these numbers? This is year 1. This is year 2, year 3. So we're looking at year 1 for Mary, 14.29. All of these numbers are a percent. I'm not going to remind you of that on the test. You're going to have worked so many problems that you will remember that. So what do we multiply times that percent? $20,000 times 14.29%. $20,000 times 0.1429. Whoa, would you look at that? We got the same number. Ta-da! So hopefully you can see how that works. Okay. You don't need to adjust this answer for the half-year convention. Remember, up here we had to multiply it by 50% or divide it by 2. You don't have to do that with these charts. These charts are smart. They are specifically for MACRS, and whoever created them knows that you can only take a half a year this year. Therefore, they use the correct number already. All right, so that always comes up on a test or on a problem. They're like, wait a minute, do I multiply this number by 50%? No, you just do exactly what the chart says. So assume Mary keeps the asset for 10 years. How long does it take Mary to fully depreciate the asset? Well, remember, she only gets a half year of depreciation in year 1. And then all of this year, 1, 2, 3, 4, 5, 6. There's 6 years, 6.5. And in year 8, how much is she going to get? Another half year at acquisition, half year at disposition. So even though it's called 7-year property, it takes Mary 8 years to depreciate it. Make sense? Okay. Now assume Mary sells the asset on September 1st of year 2 for $10,000. How much depreciation would Mary take in year 2? Okay, I go back to my charts and I find year 2, and it has 24.49%. Remember how I said these charts were smart? They know that you can only take a half a year in the year of acquisition and disposition. Are these charts smart enough to know that you're going to sell that 7-year asset in year 2? No, they don't know that. These charts assume you are going to hold it the entire time. So what will I need to do if I sell my asset early? Now I would have to multiply it by the half year. If I kept it all the way through year 8, I don't do anything. I take 20,000 times 4.46%. But if I sell it early, I take 20,000 times 24.49%. I know y'all can't see my MACRS charts anymore, but remember I gave y'all some in Canvas. $20,000 times 0.2449. I think I left off my 9 there. 2449. Yeah, I don't have Andrew here to correct me, so hopefully I'm doing this right. All right, is 48.98. Can she take that much depreciation? No, we've got to divide it by 2 because this is the year of disposition. Divided by 2, because we're disposing of it, equals 2449. So that's my answer there. She could take $2,449 of depreciation in year 2. Now it wants to know what her gain or loss is on the sale. I kind of jumped the gun up here. My selling price is $10,000. What do I do to find a gain or loss? Again, here's a common mistake. Students take this minus the depreciation you just figured. But that's not the formula. So write out your formula. It's selling price minus what? Adjusted basis. So I've got to come over here and do a second calculation to find my adjusted basis. Maybe that'll help some of you guys on the test or the quiz. It's not just one calculation, it's 2 calculations. How do we find the adjusted basis? Take your original cost of how much? 20 grand. That's how much it originally cost her. Minus what? Accumulated depreciation. That means all the depreciation over all the years. We only have 2 years in this problem, but so our accumulated depreciation would be year 2's of 2449 plus year 1's depreciation of 2858. That gives me accumulated depreciation of $5,307, right? So my adjusted basis is 14,693. Now I can use that to find my gain or loss. My selling price minus my adjusted basis equals my gain or loss. I have a loss of $4,693. Okay, you good? Take another little break if you need to. Okay, so, oh, my camera fall down. All right, talk to you about mid-quarter for a second. We've already talked about it, but I don't know if it really registers in your head until you do it. The half-year convention is only for tangible property, stuff I can touch and feel. The tangible personal property. The mid-month convention is for real property only. So really, you're just looking at buildings there, right? Because we don't depreciate land. Buildings mid-month, everything else half-year. What's this weirdo mid-quarter? And again, if you understand the why, it's going to help you remember it better. Most taxpayers are cash basis taxpayers, unless you're a real big corporation. Most everybody uses the cash basis. That means I can deduct things when I pay for them. Just like on y'all's last tax return, you paid for 2 years of property taxes in the same year. You got to deduct both of them, subject to a limitation, but you can deduct both of them. So a lot of taxpayers, this is a real thing, get to the end of the year and go, oh, what do I need to buy? Do I need a new truck? Do I need a new computer? Do I need a new this? Do I need a new that? If I need it, now's a good time to buy it because I can take a deduction for it and it reduces the amount of tax I have on this year's income. So Congress said, to keep people from doing that and unfairly taking these big deductions, and in order to keep CPAs in business and keep you guys in education, I don't know why else they came up with this. They said, we're going to create this confusing thing called the mid-quarter convention. And what it says is that if you place a whole bunch of stuff into service during the last quarter of the year, October, November, or December, then we're not going to let you use the half year because the half year says you get a half year of depreciation. And man, you only place that stuff into service in October, November, or December, okay? So they said, if more than 40% of everything you placed into service, some was in January, some was in July, but a whole bunch was in December, we're going to make you use these mid-quarter tables for everything. So here's the most common mistake I see. Looking at, hopefully you've got pulled up on your computer, looking at your MACRS charts, The half year's the first page. And then I've got 4 sheets of the mid-quarter table. On the copies I made you guys, I put a rectangle box around mid-quarter first quarter, mid-quarter second quarter, mid-quarter third quarter, and mid-quarter fourth quarter. Once you determine after looking at all your assets that you've got to use the mid-quarter tables, you use them for every asset, even the one that was placed in service in January. And you use them all the way through to when you dispose of them, even if you dispose of it in January. Okay? So get your brain around that before you actually work problems with that, okay? So look at my next problem for mid-quarter convention. It applies to tangible property, not real property. Stop and quiz yourself. What are we going to use for real property? Mid-month only and straight line only. There's another good flashcard for you. All right. If the property that was placed into service during the last 3 months of the year exceeds 40% of the cost of all the property, but after 179 in bonus. What the heck is 179 in bonus? Well, hang tight. You'll learn about that in a minute. That's why we excluded it on this problem. So here's what happened. Fur Company acquires $2.42 million of 5-year tangible personal property during the year. March 3rd. Y'all put those quarters down next to it. Stop your video. Remember when I make you do this all the time, it's because I see students have mistakes. So come back to the video. Hopefully you said January, February, March. Oh, that's first quarter. April, May, June. That's second quarter. July, August, September. I don't have anything for third quarter. And October, November, December, fourth quarter. All right. What percentage is each of these of all the assets? Again, you should also stop your video and do that because these are things that I shouldn't have to explain to you. And hopefully you're taking the time to figure it out and not just waiting on me to tell you. So in December, we had $1,090,000 of stuff. And in total, we had 2.42 million. That is 45%. Is that more than 40%? Yes. Uh-oh. So if greater than 40%, must use the mid-quarter tables. So must I use the mid-quarter tables just on the December property? No, I've got to use the mid-quarter tables on all of the property. That's why there are 4 sets of mid-quarter tables. One for the first, one for the second, one for the third, and one for the fourth. Okay, there's where I should have done 45%. All righty. Continuation of the problem. Since more than 40% of the property was placed into service in the fourth quarter, go to your mid-quarter tables. Mid-quarter, and find the correct percentages. They're still the same way by recovery periods. This problem told us we were looking at 5-year property, and we are currently in year 1 of the property being in service. March 3rd, this was our $630,000 property, times what? 35% right here. April 2nd, now we go to the second quarter property. That's where they got the 25%. December 21st, we go to our fourth quarter property. That's where we got 5%. So I think one thing about this chapter is students just don't take the time. They watch me in class or now on this video doing it, and they're like, yeah, that makes sense. But until you take the time to use this chart on your own, you don't realize if you're making any mistakes or are going to make a mistake. So it's just a chapter where you've really got to put a lot of time and effort into it. And again, I hope, like I told you guys, you use this a ton in real life, but if nothing else motivates you, hear me telling you that 40% of your exam is going to be this. Hopefully that'll motivate you to just spend some time on it. It's not rocket science. You can do it. You just got to spend some time. That's all. All righty. I'm going to come back here after discussing section 179. So, yeah, skip for now. I'm not telling you to skip. You don't have to know this. I'm saying don't look at that right now because you haven't learned about 179 property. Let's talk about disposals. I've mentioned already that you have to use the same convention. So if I started using mid-quarter, I got to finish using mid-quarter all the way through every year on that property. Um, in the year of disposition, you only get a half a year or a mid-quarter, right? So let's look at Michelle. She acquired machinery in March of 2020 that qualified as 7-year property and had a $100,000 basis for depreciation. The half-year convention applied in the year of acquisition, so in 2020, and she claimed no 179 or bonus. Y'all still don't know what that is. So on December 15th of 2024, she sells the machinery. What is her depreciation deduction for 2024? Well, let's look at 7-year property. We go back to my half-year table. This is that problem we started with. And we go March of 2020 would have been year one. Then 2020, 2021, 2022, 23, 24, blah, 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 blah. 2024. So if you need to write on this on your exam as you're practicing homework, you go 2020, 2021, 2022, 2023, 2024. Here's what year we're in, 8.93%. What is her depreciation deduction for 2024? $20,000 property. Uh-oh, was I in the right convention? Yeah, or right recovery period. Yeah, 7 years. 20,000 times 8.93% is what? I know y'all know how to use a calculator, but we're going to get to see if you remember something in just a second. Equals 1786. Did I do that right? $20,000 times 0.0893. Yeah, 1786. Is that correct? Is that my answer for depreciation deduction of 2024? No, because if she sells it and it's not in her final year, the charts didn't know she sells it. This would be how much she could take for depreciation if she held on to it all year. She didn't hold on to it all year. She sold it. You have to use the half-year convention. So I have to divide that by 2. Divided by 2. She only gets depreciation of $893. Makes sense? She's going to use, even though she disposed of it in December, she's not going to use that mid-quarter table. She's going to use just this regular old half-year table because that is what we started with. All righty. Brand new stuff now. Oh, note, I will not give you a calculation problem to dispose of something with the mid-quarter table, but I will give you a problem like we did up here, like your initial acquiring it and what that first or second or third year depreciation is. I just won't make you dispose of something in the mid-quarter. Okay, let's see. I give you permission like I need it. I know y'all can do whatever you want to. Just my advice. But I would say this would be a great time for a little break if you want to come back later. Now's a good time for a break. All right, assuming you took a break, I hope you had fun. I hope you had a great night's sleep. Whatever you've done, we will now start section 179 expense. This is something that does not exist in financial accounting. You find it in section 179 of the Internal Revenue Code. And remember, for tax purposes, we're looking at that wherewithal to pay concept a lot. And we go, hey, that just makes sense. If you spend all this money on an asset this year, you should get to depreciate the entire asset this year. I get why GAAP makes us spread it out. We're matching up that expense with the revenue it helps us earn year over year over year. But for tax purposes, man, I should get that deduction this year if I pulled the cash out of my pocket this year. So 179, it doesn't give us extra deductions. You can only deduct how much ever you spent on the thing, but it just lets you take it faster. So the property can be new or used property. I'll get to this in a minute. I'm not going to quiz y'all on this. We've actually changed a lot on this recently. Let me go ahead and circle all of these and then we'll go with it. Um, don't need to know specifics. Mostly, here's how I would remember this for now. Um, you just can't take 179 on a building. We know we can't take it on land because we don't depreciate land. And then there are some kind of funky rules that Congress plays around with really every year on if you can take it on tangible or intangible property. Really, it needs to be tangible, but we've got these weird exceptions for intangible stuff. And then Congress will play around with this also. In fact, they're doing it with the new One Big Beautiful Bill Act. Sometimes they'll say, oh, it's got to be brand new because they're wanting to churn the economy. They're wanting businesses to go out and buy new equipment. But currently it can be new or used, meaning if I need a new tractor for my business, I don't have to buy a brand new one from John Deere. I could go buy it from another farmer and it's new to me and I could still take the 179 deduction on it. Okay. So, okay. What it is, it's a more immediate expensing of it. What Congress would love to have this happen, and this is pretty bipartisan, Republicans and Democrats agree, they would like for companies to be able to deduct 100% of that cost of that asset in the first year. But we've got this revenue problem, right? Our country needs some revenue to run on, and they can't quite figure out how to make that work. Um, so we're going to learn the rules and the limitations of it. So I've already mentioned 179 expense does not apply to real property. And no fair, I especially don't like this rule. It doesn't apply to investment property. So if I've got to buy a new air conditioning unit for my rental property, which I just did, $9,000, I cannot apply 179 and deduct it all immediately. Boo. But if it's for a regular business, not my investment property, then maybe I could. So we also get into, remember how I told you, hey, you can just pretty much remember we can't 179 expense a building. Well, y'all, real property, remember the real definition was you can't move it. So that could actually be what we call an HVAC, a HVAC, an air conditioning unit. It could be a roof to a building. It could be some things like that. And so Congress plays around with this as well. TCJA Act actually came in and let us use 179 on some really specific real property like roofs and some HVAC systems. So I'm not going to test you on anything that specific. I make the point to talk about it though, because it's a real big deal in the real world. We help clients plan this way. We're talking cash flow for them. And this is a lot of the fun stuff that tax accountants get to do is sit down at the beginning of the year and go, what all do you need to buy? How are we going to take depreciation? How much cash flow are you going to be left over with at the end of the year? Okay. So an example of the type of property that 179 applies to, furniture, computers, equipment, stuff like that. Property that you couldn't use it on a building. All right. That's about as specific as I'll have you know on that. All right, here's the nitty gritty of it. A company, but Jennifer, this is an individual income tax class. I know. How many individuals do you know that own small businesses? A bunch of them. How many of them have to buy equipment for their business? A bunch of them. So it applies to individual taxpayers every day, all day. They can elect to immediately expense rather than spreading out over 5, 7, 10, 15 years. Immediately expense up to $1.22 million in 2024. Do I have to memorize that? No, I didn't leave a blank line for you. You don't have to memorize that. You do have to be able to work a problem with it. Just like on the test y'all just took, I gave you mileage on the front page, business mileage. I'm going to give you depreciation and 179 stuff on this test. This amount gets adjusted each year for inflation. It was 1.16 last year. And I think it goes, oh, look, I wrote it. It goes to 1.25 in 2026. Might have gone to that in 2025. I can't remember. If the One Big Beautiful Bill Act doesn't change it. Okay, it allows you to expense that immediately, just like the supplies that you bought, just like the salaries that you paid, just like your utilities that you're going to deduct. And then we've got this other type of depreciation next called bonus that we'll talk about. But let's stay with section 179. And that's just what people call it. It doesn't have another fun depreciation name. It's just called 179 depreciation. I guarantee you, every business person out there that you talk to, they've never had an accounting class in their life. They know what 179 depreciation is. So, okay, in July 2024, Tanya acquires and places into service equipment costing $1,320,000. It has a 7-year maker's life. That's the recovery period. She's going to use it 100% for her business. That means she can depreciate the whole thing. And this is the only property she places in service this year. Why did I tell you that? Why does that matter? Because that means she can use, where did I throw my tables? Oh, I'm just at my desk, but somehow I've lost my tables. Here they are under here. That means she can use these half year. If that's the only thing she placed into service, she's not going to have to use the mid-quarter, okay? So, Tanya expects to expense the maximum amount that she can under 179. How much can she expense? 1320 is her total asset cost. The max 179 is 1220. Max 179. So should she take all of that? Yeah, if she wants to do the max, your answer is 1220,000. I write them side by side to tell you this. What if she had placed into service just $1 million worth of stuff? Then what's the most of a deduction she could take this year? Well, then it'd be just $1 million, right? You can't do more than this, but you also can't take this whole amount as a deduction if you only spent $1 million. Remember, you can never deduct more than the cost of the asset. So hopefully that makes sense. So what is her basis after the 179 expense? Ruh-roh, I filled in the wrong blank there. This is her 179 deduction. She would put it on Schedule C as a deduction. Her basis after taking that would be $100,000. Original cost minus the depreciation equals adjusted basis. So her basis is 100. Got it? All right. Now what? Now she moves on to MACRS depreciation. This was just some extra, not some extra, some faster depreciation she can take this year. So now we look at this MACRS chart, and what do we do with it? We go, what year? 7-year property. We're in the first year. So we've got that 14.29%. What am I going to multiply by 14.29%, y'all? $100,000, not the whole 13.2. Whatever's left is what we use for MACRS. So her total 2024 depreciation expense would be that 100 grand of the 179 expense plus 14,290 MACRS depreciation. That's your answer, 114,290. Definitely stop and take the time to go over this. Email me, whatever, if you have questions, and get this down before you move on. I want you to go one step further, though. Go to year 2 for Tanya. What is her depreciation going to be year 2? Depreciation year 2. We would take that same $100,000 basis and multiply it by 24.49%. Okay, makes sense? All righty, now for the little bit harder part. There's a limitation on 179 expense. Here's the most amount of deduction we can take in year 1 for 179. I know we took more than that, but one was 179 and one was MACRS. When I speak of limitations, this is a small business limitation. You know how we've done that with a lot of things this semester? This is Congress saying, look, if you're some big company like Walmart or Exxon, you don't need this faster expensing. Y'all are doing just fine. We're just trying to help out the small mom and pop type businesses here, okay? So the max amount of the actual expense you can take is the 1.22, but you are also limited based on how much property you placed into service during the year. This is already written in for you. You don't have to memorize it. I will give you this and I will give you this on an exam. If you place more than $3,050,000 of property into service in 2024, Congress goes, uh-oh, you're not a small business anymore. We are going to start taking away how much you can expense immediately with 179 on a dollar for dollar basis. Does this sound familiar, y'all? This is like those business investigation expenses you just did on that test. When we spent more than 50 grand, Congress said, uh-oh, you're not a small business anymore. We're going to take away that immediate $5,000 dollar for dollar until you can't immediately do anything. Can you still expense them? Sure. It was over 15 years. So same here. We're going to start taking it away. Can you ultimately expense all 1.32 million? Yeah, we're just talking about, can you do it faster here? If you're too big of a company, they're going to make you spread it out over the 7 years and not take any immediately. So what does that look like? Again, every dollar you go over 3,050,000, you start losing a dollar of that 179 expense. So we'll work a problem with it, but let me show you something. If your total costs were 4.27 million, the ceiling or threshold, or whatever you want to call it, for small businesses is 3.05 million, then that means you lose 1.2 million of the 179 deduction. How much 179 deduction could you take? 1.2 million. So there's your cap for 2024. If you spend over this amount, you're not getting any 179. You just got to depreciate it like normal, okay? All right. The taxpayer must elect, these are rules. So the taxpayer must elect to take the 179 deduction. I actually do want you to know that, so I wish I had left a line blank for that. That's important because it doesn't happen automatically. If you're the business owner or you're their CPA, you have to actively go in and make an election and tell IRS, I want to take this year. Why would you choose not to? Remember, overall, we say, heck yeah, take that deduction as fast as possible. We already spent the money. I don't want to pay taxes on it. Why would you maybe not want to use it all this year? Well, like I said, we talked about a bit ago, what if it's a brand new business and you don't even have any income this year? Then a bigger deduction is not going to do you any good. You already don't have any taxable income. So that might be one reason why you wouldn't want to. But a lot of people definitely choose to make this election. Okay, notice with our example with Tanya above, she did not get limited. She got to take all $1.22 million of the 179 expense. Why? Because she did not place more than 3.05 of property into service. She only placed 1.32 million into service. Didn't place more than 3 million. So she was good. She did not get limited. Let's work a problem with a limitation. Now assume during 2024, Tanya placed 3.79 million into service. It's all 7-year property. It's qualified for 179 if she wants it. She has gone over the limit. I'm going to write that limit down, $3,050,000 property ceiling. She spent 3,790,000. Her total, I'll say total spent. She has gone over the limit. So the first thing you do, just like we did with those business investigation expenses, is figure out how much did she go over the limit. Well, she went over it by $740,000, right? Okay. So her max 179 expense gets reduced by this. This reduces the 179 expense dollar for dollar. So what was that max 179 deduction? Again, you don't have to memorize it. I'll have it on the first page of your exam. For 2024, it was, what was it, 1.22, I think? Yeah, $1.22 million. It gets reduced by $740,000. So how much can she take? 1,220 minus 740. She can take 480,000 of 179 expense this year. Okay, how much does she have left to depreciate, y'all? Just like I told you at the review and in class, this is the part where people messed up on the business investigation expenses. Usually there's actually was one more that two people did. I'll go over in class on Monday, but how much does she have left that she wants to depreciate? Well, again, start back with her total. Not this, that's not her total, that's just a threshold. This is just a threshold. She really spent $3.790 million. She's going to take 480 of it in 179 expense. So that leaves her $310,000 basis to still depreciate, right? Okay. Let me write that there. 3310000. I hate that I'm talking and doing this and whatever at the same time, because that's going to be terrible if I made a math mistake somewhere and y'all are screaming at the video. I can hear Alex, no, it's not, you added wrong. So God love me. Hopefully I didn't add or subtract wrong in my head, because y'all know I don't do that well. All right. Now she can take the MACRS depreciation on this amount. That's how much she has left to depreciate. So we look at our MACRS chart. It was 7-year property. We're in year 1 of it. 14.29 is our percent. Times how much ever else she has left to depreciate. 3310000. I don't know. 472,999. Hopefully that's right. So what is her total cost recovery, her total depreciation deduction this year? Here's the second most common mistake y'all made on that first exam. I know not everybody did. I'm just saying, if there was a mistake, here was the second most common one. It was y'all forgot to add together the amortization expense plus the immediate expensing. So we're going to do the same thing here. We get to take our 179 expense plus our MACRS this year. Those are both depreciation deductions for this year. I don't know, y'all, that number's not ringing any bells, but I just don't want to stop and go back and add. So somebody, first person through this, finds a mistake, I'll send out I'll send out an announcement if there's one. All righty. That's the calculation part. What's the stuff you need to know about 179? Well, the property must be, we've already mentioned this, for an active trade or business. I can't use it for those investment type things for the production of income, like my rent houses. It's got to be used at least 50% for business. So like my car, personally, I use it part for work, part for business. So it's got to be mostly business. Cannot be, cannot be acquired from a related party or by gift or inheritance. The 179 deduction, oh, there's some fill in the blanks here. This must be important, must be some new stuff. Cannot exceed the taxable income from the trade or business. There is an example in the book where you need to look at this problem. What happens to the leftover? We carry it over to next year. So stop for just a second. Those are just words. If I give you a calculation problem on this, are you going to be able to remember those words and apply it on the test? A lot of students forget about this. What it's saying is that before I find this depreciation deduction, I've done my revenues minus all of my expenses, deductions for tax purpose, except for depreciation. I find that number, and then I compare it to how much depreciation I can take. And the 179 piece of it cannot be more than my taxable income. The MACRS piece can, but the 179 cannot. So suppose I had a business with, you know, $600,000 worth of revenues and $300,000 of deductions. I've only got $300,000 of income before looking at this 179. I couldn't take all 480. I could only take 300 of it. That's what that means. There is a problem in your book. There are lots of great problems in your book. You just need to take out a pen and paper and work them rather than just like reading through it. You know what I mean? Okay. I've said that 100 times. It's in red. Read it again. Go back now and look at the example on page 8 where I said I'll come back to this problem and see how we can use this in tax planning for ourselves or our clients. Remember, we had to use the mid-quarter tables here, which result in less depreciation. Well, if I take 179, I choose which assets I'm going to use it on. Number one, for this problem, oh no, here's my amounts. I could choose this asset, or this one. You know what I would choose? I would choose this December one because I'd just 179 all of that sucker. And then I don't have more than 40% of my stuff placed into service in the fourth quarter, and I don't have to use the mid-quarter tables. I get to use the half-year tables and get more depreciation. So there's really, like, you could do a whole semester class on just depreciation. There's so much planning and cool stuff you can do with it. You get into present value stuff, but we're just learning the baby steps, even though it seems like we're doing an awful lot. I know it is a lot. Okay, that was section 179, y'all. Remember right here, I put a number 1. Here's some extra kind of depreciation stuff. Well, here's a number 2, bonus depreciation. It's also called additional first year depreciation. So clear your head if you need to, and then let's learn something new. Okay, y'all are gonna laugh, but I'm gonna come over here and tell you something real quick. And if I was a better editor, I've told you this already, then I wouldn't have to tell on myself. I'm actually gonna stop there. It's today's Monday. Y'all just took your test. I'm going to finish pages 11, 12, and 13 later. And then I have a totally separate video for depletion, because I'm old and my old lady Mahjong and Wine Club is meeting tonight, and it's 5:04. I gotta go get ready for that. So I'm going to wrap this up and email me questions as you go through this. But the bottom line is work problems, work problems, work problems to get this. I'll make y'all another video tomorrow. Bye.